With the collapse of Silicon Valley Bank, U.S. finance saw its biggest bank failure since the crisis of 2008. But how real is the risk of contagion in the broader system? The collapse of SVB is tied to recent quantitative tightening. These days, a company's valuation can in practice be an imprecise and impulsive metric that is becoming increasingly subject to social psychology. For example, the difference between Tesla and Toyota. Toyota's yearly production absolutely dwarfs Tesla's, as does its yearly revenue. But Tesla is the world's largest car company by market cap. Toyota's stock operates like most other car manufacturers, evolving based on production figures, commodities markets, and sometimes geopolitical risks. But Tesla's stock behaves like other tech companies, a hype-based financial model that's extremely sensitive to, well, strong emotions. SVB's client base is mostly tech startups, so it was very sensitive to quantitative tightening, which cut off SVB's access to capital, causing a run on the bank. And the government has already stepped in to ensure that all investors walk away with their money. So who's the real loser? Whoever's trying to fund the next Snapchat clone. The fallout from the failure of SVB hasn't resulted in a cascade of collapsing banks, but it has panicked investors and consumers alike, as well as forcing the government into issuing many assurances to asset holders. Let's assume the worst. If the banking sector was threatened because a run on the banks was initiated, we would see contagion, with one bank collapsing after the other. This would spread outside of the tech sector, exposing other banks to instability. Companies would lay off as many employees as possible to save on costs, while households would spend less and less, and we would enter a recession. For now, the signs are still pointing towards stability. While inflation in major economies continues, many of the forces behind it have been halted, and there have been no major changes to consumer spending, employment, or growth that could signal that quantitative tightening has had an undue impact on the economy. This isn't universally true, but it was true enough that the European Central Bank decided to raise interest rates again by half a point on the 16th of March. This brings up another concern, that central banks may be too focused on fighting inflation. If that were to trigger more bank failures, it could very well be too late to stop the panic train from leading to systemic collapse.
Is the tech sector about to fall off a cliff? Does that herald a global recession? Let's test this by taking a closer look at how consumer spending works. Recently, there's been a lot of talk about soggy demand, i.e. falling consumption. But not all spending is the same. People don't spend money interchangeably on rent, tech, and gas. There's a hierarchy. Spending in tech is usually viewed as discretionary. Consumers don't need to spend money there, so when a recession hits, tech spending is usually one of the first things to go. There's been a lot of talk about layoffs, restructuring, and instability at companies like Meta, Amazon, Twitter, Netflix, and Google, but this ignores that demand in other industries driven by discretionary spending is way up, such as tourism. During the pandemic, consumer electronic and tech companies like Nvidia and Apple purposefully overstocked while faced with the possibility of shortages because of issues with the supply chain. But as the industry begins to adjust prices downward to eliminate their excess inventory and consumer prices start falling, many analysts will view this as an omen of imminent catastrophe. So, what do we do with all this information? Well, wait and try not to panic. Economic data has never been muddier because the economy has never been so massively impacted by geopolitical factors. A lot of analysts have never seen this sort of crisis and, frankly, don't know what to do with the data. But what boosts views? Fear.
Subscribe for more on geopolitics, markets, and technology.